2022 has been a brutal year for stock and bond investors. The S&P 500 is down about 18% from its most recent high. Is the stock market a good buy right now, or is there more room for the market to fall? In this video, I'm going to show you a regression model, and we're going to look at different scenarios for what might happen with the S&P 500 based on different scenarios. And at the end of the video, I'll share with you my probabilities for each of the 5 different scenarios and estimate what I think the S&P 500 fair value is right now.
This video is for educational purposes only. It should not be considered investment, legal, or tax advice. It is not an offer to buy or sell any security. Past performance does not indicate future results. Investing is risky.
So first, let's talk about how I came up with this data. To estimate different scenario fair values, I took a look at a regression using data back to 1960. I used 2 very important variables, the current 10-year US Treasury yield and the current trailing 12-month earnings. Both of those were in log, the earnings were in log, and so was price. The objective was to try to predict with these 2 variables what the price of the S&P 500 should be based on those inputs. Since 1960, those 2 inputs, earnings and US Treasury yields, have predicted 94% roughly of the movement in the S&P 500's price over time. In other words, if you knew exactly what the S&P 500's earnings per share would be 50 years from now, and you knew exactly what the 10-year US Treasury yield would be 50 years from now, you would be able to estimate with a fair degree of accuracy what the S&P 500 would be trading at that time. This chart shows the historical predictions. So you can see that the orange line represents the forecast, so what the model thinks the S&P 500 should have been trading at each point in time given the inputs. So for example, in 2000, using whatever the S&P 500 earnings were at this time and whatever the 10-year US Treasury was at this time, the model predicted that the S&P 500 should be trading around here. This green line represents where the S&P 500 was actually trading at that time. So we can take these coefficients and plug in what the current values are for the S&P 500 and the 10-year US Treasury, and we can calculate roughly what we think the market should be given those inputs. Let's do a quick review of what regression is, or a quick introduction if you've never heard of regression. Let's say we've got on this column we have PE ratio, and on this column we have the 10-year US Treasury yield. So what our regression model is doing is it's looking back at all of these different monthly observations from 1960 to 2022. And it's basically saying, okay, what was the price to earnings ratio at that time? And what was the 10-year yield at that time? So let's say we've got different yields here. We've got 1%, 2%, 3%, and so on. And then on the left, we have different PE ratios. So we've got, say, 10 times earnings, 20 times earnings, and 30 times earnings. So if we go back to different months, we can plot where the PE ratio was and where the 10-year yield was. So back in, say, the start of 2000, the PE ratio for the S&P was, say, here, and the 10-year yield was, say, here at 5.5. So we can go up and plot this X based on those 2 numbers. And let's say back in, say, 1975, when interest rates were way out here, the PE ratio for the S&P might be, say, here. And then in March of 2022, the trailing PE for the S&P is right about 20, and the 10-year is at 2.8%. So we could plot this at right around here. So over this whole time period, we're going to have all kinds of different readings. And so what the regression is going to do is it's going to look at all these numbers, and it's going to say, is there a clear pattern, or at least what is the best fit for this particular model? So the line will probably look something like this. So this suggests that if interest rates are at, say, 0%, the PE ratio for the S&P should be around 30. I'm just making these numbers up. If the 10-year yield goes up to, say, 3%, the PE ratio should drop to, say, 25, and on and on. If the 10-year is over 10%, then the PE ratio for the S&P should be below 10. Again, this isn't real data, it's just an illustration, but this is roughly what's happening. And this is generally accurate with what we see both historically and what you could assume logically. If interest rates are low, investors should be willing to pay more for both bonds and stocks. So the PE ratio, the price to earnings ratio, will be higher. If interest rates go up a lot, the competition for stocks is a lot more significant, so the price to earnings ratio should decline. Here are different scenarios based on what might happen through the rest of 2022 and on into 2023. The current earnings for the S&P 500 is $197. That is the trailing 12-month earnings per share. The current interest rates are 2.8%. So what I've done is to look forward to, say, the end of 2022 and calculated what earnings might be in each of these different scenarios. Okay, so the first scenario we have is growth. Some analyst forecasts are currently for about 9% earnings growth in 2022. So if we look at the 197 number and assume that grows by 9%, that gets us to an earnings per share at $214. In this scenario, that means the economy is likely growing. It means inflation is probably coming down a little bit, but probably still remaining a little hot. It is likely that the 10-year US Treasury yield would creep up in this kind of environment. So I've assumed that the interest rates, the 10-year interest rates at year end, in this scenario would be 3.8%. So if we look at our regression, the estimated PE with interest rates at 3.8 is 21.7. So all we have to do is multiply 21.7 by the estimate for earnings at 214, and that gives us a predicted fair value of the S&P 500 in this scenario at $46.50. In the second scenario, we've got earnings flat for the year. So in this case, the economy doesn't go into recession, but we also don't get growth. Basically, earnings just muddle along and remain constant through 2020. In this scenario, interest rates probably either stay flat or maybe move up a little bit as recession odds start to fall off. So let's say the interest rate in this scenario is 3.3. That means the estimated PE ratio would increase a little bit based on the lower rates. So if we take 22.7 multiplied by 197, that gets us a prediction in this scenario of 44.80 for the S&P. Now let's say what everyone is currently fearing comes true and we fall into a recession. What would happen to earnings if we went into a normal recession? To find out, I took a look at the earnings per share declines in historical recessions. So if you look at the top to bottom decline for the preceding 2 years to where earnings eventually bottomed out, it's about a 22% average reduction in earnings, at least back to 1960. So if we get a normal recession and earnings would fall by 22% from 197 to 153, and interest rates in this scenario probably would stay about where they are. They might even drop a little bit lower. Typically, rates fall in a recession. The estimated PE would actually go up a little bit counterintuitively because rates are lower. So if we take the earnings per share at 153 multiplied by the estimated PE in this environment, that gets us to a fair value of 36.40. Now we get into the stagflation scenario, which is where we get a normal recession and we get a huge spike in interest rates that continues through the end of the year. In this scenario, we see the price to earnings ratio estimate fall significantly to 16.4 on a trailing basis. If we multiply the earnings per share, which would be 22% lower, and a lower PE, that gets us to a fair value prediction of 2,500. And then finally, let's say we get another great recession like we had in 08-09. In 08-09, the interest rates actually completely collapsed. They fell by about 1.5% from 07 to 09. If that were to happen again, the 10-year would drop from 2.8 to 1.3. Earnings in the Great Recession fell by 90%, which would go from $197 to $20 in our current scenario. But also the S&P 500's PE ratio, if you look back, actually went up to over 100 times in 08-09. Why? Because the market is always looking ahead. So in 08-09, when earnings were at their absolute minimum, the market was looking forward and saying, well, the economy is starting to get better, earnings should recover significantly, and they did. So if earnings actually fell to $20, it's likely the PE ratio for the S&P would be pretty high. We'll say it gets to 120, which is a fair value prediction of 2,400. So now let's assign some probabilities to each one of these scenarios and come up with a probability-weighted estimate for what the S&P 500 might be trading at year end. So in these 5 scenarios, I'm going to assign about a 30% probability to a growth outcome, a 40% probability to a flat outcome. There's an increasing odd of recession. We'll say normal recession odds, I think probably around 20% at this point. And then the 2 kind of worst case scenario recessions of stagflation and then an 08-09 type scenario. I think both of these are probably fairly unlikely, but we'll assign them 5% probability each. If we look at the predicted value under each one of these scenarios and calculate the percentage change, so in the growth situation, I'm estimating about an 18% increase through the end of the year. If we multiply 18% by my probability of 30%, that gets us to a weighted estimate of 5.3. If we do the same for all of these other scenarios, each one of them has an impact on the overall calculation. So the Great Recession scenario, this suggests the market would drop another 39%. Since it has such a low probability, that gets only a negative 2% on the weighted score. So calculating all of these, my weighted probability estimate for the S&P by year end is about 5.4% higher than where it's at today. If you tack on, say, another percent and a half for dividends, that would come out to about a 7% total return through year end. However, keep in mind that the actual outcome is going to be probably more extreme. So if we get into this growth scenario, where we start to see the economy is actually doing pretty well, earnings continue to grow, et cetera, the market is much more likely to have a relief rally and start to move towards this predicted value. Meanwhile, if we get this stagflation scenario and rates keep rising and the probability of recession continues to rise, the market's going to continue to edge down towards some of these lower numbers as it incorporates more and more bad news. So this is absolutely not precise. I'm not necessarily sitting here and saying you are going to make 7% if you buy stocks right now. No one knows for sure. This is just kind of my best guess, best estimate of the different outcome potentials and what might occur going forward. Thanks for watching, and I will see you in the next video.